Many investors believe success comes from complex strategies or perfect timing, yet most losses come from simple mistakes. Long before recognition, one young investor struggled to understand why markets felt irrational and emotionally exhausting. He was not chasing fast money or excitement. He wanted a logical framework that could survive fear, mistakes, and uncertainty without relying on predictions or constant activity. During this search, he encountered ideas that felt almost too simple. There were no forecasts, no shortcuts, only a disciplined way of thinking about value and risk. This approach treated stocks as pieces of real businesses, not symbols on a screen. What mattered was what a company owned, earned, and could sustain over time. A crucial insight appeared early: price and value are not the same. Markets often confuse popularity with worth, creating dangerous gaps between perception and reality. Paying less than something is worth offered protection. Paying more, even for quality, quietly increased risk without warning the investor until it was too late. This idea reframed failure itself. Losses were not always bad luck, but often the result of ignoring value and letting emotions drive decisions. Another lesson focused on discipline. Many investors fail not because they lack intelligence, but because they struggle to remain patient when prices move against them. Emotions were identified as the real enemy. Fear during declines and greed during rallies quietly push people into decisions they later regret. These lessons did not promise excitement or speed. They offered something steadier, a way to remain rational, protected, and calm when markets tested patience. One of the most important lessons was separating intelligence from behavior. Even very smart investors fail when emotions override judgment during short-term market movements and temporary losses. The framework taught that investing is not about being right every day. It is about avoiding serious mistakes and staying reasonable over long periods of uncertainty. A core principle introduced was the margin of safety. This meant buying with room for error, accepting that assumptions can fail and outcomes are never perfect. Instead of trusting forecasts, the approach relied on conservative thinking. If an investment only succeeded under ideal conditions, it was not truly safe. This mindset encouraged humility. It accepted uncertainty as permanent and focused decisions on what could go wrong, not just optimistic outcomes. Another lesson challenged constant activity. Frequent trading often reflected discomfort with waiting rather than genuine improvement in investment results. Inactivity was reframed as strength. Doing nothing when opportunities were unattractive protected capital and preserved mental energy for better moments. Patience removed pressure. Investors no longer needed action to feel productive, reducing impulsive decisions driven by boredom or fear. Success began to look different. Avoiding large losses became more important than chasing impressive but fragile short-term gains. Gradually, excitement faded. Investing became calmer, slower, and more intentional, led by preparation rather than prediction. Another important lesson was learning to see market declines differently. Falling prices were not automatically signals of danger, but moments that required careful evaluation of underlying business value. Markets were described as emotional crowds, not precise calculators. Prices often reflected fear or excitement rather than careful reasoning, creating opportunities for disciplined investors. This idea changed the role of volatility. Instead of fearing it, the investor learned to expect it as a normal part of long-term ownership. The philosophy discouraged following popular opinions. When everyone agreed, prices usually left little margin for safety and increased hidden risk. Independent thinking became essential. Decisions were based on business fundamentals, not headlines, trends, or the opinions of others. Simplicity was another guiding rule. If an investment could not be explained clearly, it likely carried risks that were not fully understood. Complex strategies often hid uncertainty. Simple reasoning, grounded in business reality, reduced errors and improved consistency over time. Temperament was valued over talent. Emotional stability mattered more than advanced models or clever financial calculations. This revealed a quiet truth. Most mistakes came from impatience, overconfidence, and fear of missing out, not lack of information. With these lessons, investing slowly transformed into a thoughtful process focused on restraint, understanding, and long-term perspective. Risk was redefined in a way that surprised many. It was not daily price movement, but the chance of permanent loss caused by poor decisions or paying too much. This definition changed perspective. Calm markets could be dangerous when prices ignored reality, while volatile markets could be safer when value clearly exceeded price. Careful reading became essential. Annual reports revealed how businesses performed across cycles, far more honestly than headlines or short-term commentary. Management behavior mattered deeply. Leaders who allocated capital wisely and acted with integrity often mattered more than rapid growth that could quickly reverse. Another lesson emphasized knowing limits. Admitting what you do not understand protected capital better than forced confidence in unfamiliar areas. This led to a personal circle of competence. Investments stayed within businesses that could be understood without stress or heroic assumptions. The philosophy rejected owning everything. Concentration, when done patiently, reduced noise and allowed deeper understanding of fewer businesses. Time was treated as an ally. The longer a solid business compounded quietly, the less relevant daily price swings became. Short-term results stopped being the scorecard. Progress was measured by better decisions and fewer emotional mistakes. This mindset built quiet confidence, not confidence in prediction, but confidence in preparation and disciplined thinking. Time horizon became a central focus. Short-term thinking was viewed as one of the biggest disadvantages investors created for themselves. When attention stayed on weeks or months, small setbacks felt overwhelming. Long-term thinking softened these shocks and restored emotional balance. The philosophy taught that markets reward endurance more than brilliance. Staying invested through uncertainty often mattered more than perfect timing. This approach reduced regret. Missed opportunities felt less painful when decisions were grounded in discipline rather than impulse or imitation. Another warning involved success itself. Periods of strong performance could quietly encourage overconfidence and riskier behavior. Humility acted as protection. Assuming you could be wrong kept position sizes reasonable and expectations realistic. Opportunity cost became clearer. Capital tied up in average ideas was unavailable when truly attractive opportunities appeared. Patience created flexibility. Waiting preserved options instead of forcing decisions into barely acceptable investments. Urgency faded. There was no need to act simply because markets moved every day. Over time, investing became less reactive. Decisions slowed down, were reviewed carefully, and allowed to unfold naturally. Emotional pain was addressed directly. Losses often felt heavier than gains felt satisfying, pushing investors to abandon sound principles at the worst moments. The framework helped reframe losses as information. Mistakes became lessons to study, not personal failures that demanded immediate emotional relief. This encouraged reflection instead of reaction. Investors learned to pause, review decisions calmly, and avoid trading simply to reduce discomfort. Comparison was another hidden danger. Measuring results against others increased envy and distracted from personal goals and long-term plans. Every investor's situation was different. Time horizon, temperament, and needs mattered more than matching someone else's returns. Acceptance played a key role. Markets would always be uncertain, and no system could remove risk entirely. Accepting uncertainty reduced anxiety. Instead of chasing certainty, focus shifted to probabilities and preparation. Consistency became more important than intensity. Repeated good decisions, even small ones, quietly compounded over time. This approach reduced burnout. Investing no longer required constant attention or emotional energy. With discipline in place, patience stopped feeling like sacrifice and began to feel like strength. Over time, these lessons shaped an investor who valued calm over excitement. The influence of Benjamin Graham built a foundation based on logic, caution, and respect for uncertainty. His most famous student, Warren Buffett, carried these ideas forward while adapting them to real-world experience, keeping discipline and value at the core. The wisdom was never about predicting markets. It focused on preparing the mind to behave rationally when emotions were strongest. Fear, greed, impatience, and regret were treated as signals, not commands. Recognizing them created space for better decisions. This philosophy encouraged slowing down. Slower decisions reduced errors and prevented reactions to temporary noise. The true advantage became psychological. While others chased trends or panicked, a prepared investor stayed grounded in process. Investing became less about proving intelligence and more about avoiding avoidable mistakes. The lessons never promised certainty or success. They offered a realistic framework to improve odds by aligning behavior with reality. Over decades, this approach showed that compounding works best when paired with patience and humility. In the end, the greatest lesson was simple. Successful investing begins with mastering how you think and behave over time.